Capital and Investment Strategy for 2026. Ladies and gentlemen, welcome to 2026, the year where investors wake up, open their apps, see one green candle, and immediately whisper, "We are so back," right before inflation, oil, geopolitics, and interest rates slap them in the face like reality's unpaid bouncer. Because this year is strange. The global economy is still growing, technology investment is still powerful, AI is still pulling in money like a casino with holy water. But at the exact same time, inflation is proving harder to kill than a movie villain. Energy markets have been rattled by Middle East conflict, and central banks are no longer in the business of handing out free candy to reckless capital. Global growth for 2026 was projected by the IMF at 3.3% in January, but the OECD's March 2026 interim outlook cut its own current projection to 2.9% and lifted G20 inflation expectations to 4.0% because of the energy shock. So the question is not, what stock will moon by Friday? That question is how portfolios turn into cautionary documentaries. The real question is, how do you build a capital and investment strategy for a year where growth exists, but fragility is everywhere? That is the game. And today, we are going deep. Why 2026 feels so confusing? 2026 is confusing because it is a split-screen year. On one side, you have resilience. The IMF said global growth was being supported by technology investment, easier financial conditions, and private sector adaptability. The OECD also noted that strong technology-related investment is still a tailwind, especially in the United States. On the other side, you have pressure. The OECD now says higher energy prices and supply chain disruptions are pushing costs up, lowering demand, and raising inflation expectations. In its March 2026 report, it projected global GDP growth at 2.9% in 2026 and G20 inflation at 4.0%. So investors are standing in the middle of the road like a man trying to cross traffic while reading a motivational quote. That is why people feel lost, because the old playbook was simple. Rates down, buy risk. Money cheap, buy more risk. Central bank blinking, buy ridiculous risk. But 2026 is not a cheap money fairy tale. It is a capital discipline year. The macro battlefield. Let's build the battlefield map. In the Fed's March 2026 projections, the median outlook showed U.S. real GDP growth at 2.4% for 2026, unemployment at 4.4%, PCE inflation at 2.7%, core PCE inflation at 2.7%, and the median federal funds rate at 3.4% by year-end. Read that slowly. Growth, positive. Inflation, not dead. Rates, lower than the peaks, but still high enough to punish stupidity. That means capital is no longer free, and therefore bad ideas are no longer cute. A bad company with a charming pitch deck and disruptive vision now has to survive in a world where funding costs are real. And when funding costs are real, gravity returns. In Europe, the ECB's March 2026 staff projections put euro area inflation at 2.6% in 2026 and growth at just 0.9%, which tells you something important. This is not just an American puzzle. It is a broader developed market world dealing with slower growth and still uncomfortable price pressure. So the first law of investing in 2026 is this: stop asking what is exciting, start asking what can survive expensive money, sticky inflation, and geopolitical shocks. That one sentence alone can save people a lot of pain, and possibly prevent at least 3 unnecessary podcast appearances. Where dumb capital dies. Dumb capital usually dies in the same places. It dies in excessive leverage, it dies in fantasy valuations, it dies in businesses that need perfect conditions to justify their price. It dies in assets bought for narrative instead of cash flow, quality, or scarcity. In a world where inflation is still elevated and rate policy is not ultra-loose, the market becomes less forgiving. That does not mean speculative assets vanish. It means they become more violent, more selective, and less merciful. The Fed's own projections still keep inflation above target in 2026, while the OECD says the energy shock has raised inflation expectations further. So if your strategy for 2026 is buy whatever went up last month and pray, that is not a strategy. That is emotional improv. And emotional improv is how people turn bull markets into therapy sessions. Where patient capital wins. Now the good news. Patient capital can thrive in this kind of environment. Why? Because when capital has a price, discipline gets rewarded again. In 2026, the winners are more likely to be found in 5 buckets. 1. Businesses with real cash flow, pricing power, and balance sheet strength. 2. Assets or sectors tied to long-duration structural trends, especially productivity and AI. 3. Selective defensive income, because rates are still meaningful. 4. Real assets or hedges that matter when inflation or energy reaccelerates. 5. Liquidity itself. Dry powder is a position. That last one offends people because cash is boring, but boring is underrated. Sometimes cash is not cowardice. Sometimes cash is ammunition. And in a year where the Fed's projected policy rate is still 3.4% and short-duration yields remain relevant, idle capital is no longer an embarrassing cousin at the family reunion. The barbell strategy for 2026. If I had to summarize a sensible 2026 framework in one phrase, it would be run a barbell. On one side of the barbell, high-quality defense. On the other side, high-conviction growth. In the middle, be very careful. Why? Because the middle is where investors often overpay for safe-enough businesses that are not truly defensive, or growthish names that are not truly exceptional. So what does the barbell look like? Side 1, defense. This is your quality cash generators, short-duration income, strong balance sheets, essential infrastructure, and businesses that can pass costs through to customers. Translation: in 2026, a good company is not just one with a cool future, it's one that doesn't need a miracle every quarter. Side 2, growth. This is not buy every company that says AI. That is not investing. That is cybernetic astrology. This side is for businesses positioned to benefit from productivity, compute, semiconductors, digital infrastructure, automation, or software leverage, but only where valuation, moat, and execution still matter. Both the IMF and OECD identified technology and AI-related investment as a meaningful support for growth in 2026. And then you leave room for optionality, cash, hedges, and the ability to move when markets misprice fear. That's how adults allocate capital. Asset by asset framework. Let's make this practical. 1. Equities. Favor quality over junk. Favor durable earnings over stories. Favor companies with margins, free cash flow, low refinancing stress, and some pricing power. Translation: in 2026, a good company is not just one with a cool future, it's one that doesn't need a miracle every quarter. 2. Bonds and cash equivalents. Don't ignore yield. After years when safe returns were microscopic, now investors live in a world where short-duration instruments can actually contribute meaningfully to portfolio construction. With the Fed still projecting a 3.4% year-end policy rate, cash and short-duration fixed income remain strategically relevant. 3. real assets and inflation hedges. If an energy shock can still move global inflation materially higher, then inflation protection is not paranoia, it's portfolio engineering. The OECD explicitly tied its 2026 inflation upgrade to energy prices and supply chain disruptions. 4. Global diversification. Don't assume every region moves the same. The OECD's 2026 projections differ sharply across the US, Euro area, and China, which means broad diversification still matters, but blind diversification does not. You want exposure with a thesis, not exposure because it looked sophisticated in a pie chart. 5. Venture, private deals, and speculation. Demand a margin of safety. Demand clearer timelines to profitability. Demand less nonsense per slide. In expensive money regimes, fantasy gets repriced, often brutally. The biggest mistakes to avoid. Here are the 2026 portfolio sins.
Mistake 1. Confusing lower rates with easy money. Rates may be below the cycle highs, but policy is still restrictive enough to matter. Mistake 2. Treating AI as magic dust. AI may be a real macro tailwind, but that does not make every ticker with AI strategy a good investment. The tailwind is real, the hype tax is real too. Mistake 3. Ignoring geopolitics. Energy and supply chains can reprice inflation very quickly, and 2026 has already shown that. Mistake 4. Going all in on one macro outcome. If you build a portfolio that only wins if inflation collapses or only wins if growth explodes, you are not diversified. You are making a prophecy, and markets love humiliating profits. Closing message. So what is the capital and investment strategy for 2026? It is not panic. It is not euphoria. It is not chasing every headline like a caffeinated squirrel with a brokerage account. It is this. Build around resilience, own quality, respect cash flow, keep liquidity, use a barbell. Stay exposed to real growth, especially productivity and AI-linked opportunity, but refuse to worship hype. And above all, remember that this year rewards disciplined capital allocation more than blind optimism. Because 2026 is not a year for tourists. It is a year for investors who understand that capital is a soldier. Every dollar you deploy must have a mission. Every position must justify its existence. Every risk must earn the right to be in your portfolio. That is how wealth survives noisy years, and that is how serious money is made when the crowd is distracted.